Well, good afternoon, ladies and gentlemen, and a very warm welcome to the first of a series of 1 hour lunchtime webinars that we're running, a professional advisor in association with our partners, Schroders. I'm Andrew O'Kelly with Professional Advisor, and I'll be chairing the event today. We'll be talking today for the next hour about intergenerational wealth opportunities. And we've got some fabulous speakers joining us today. From Schroders, their UK Intermediary Solutions Director, Gillian Hepburn, and putting the case, or taking the side of the advisors, if you will, the Managing Director of Unique Financial Planning. He's a great friend of professional advisors, Philip Martin. Before we get into the webinar proper, I just need to run through a couple of housekeeping issues with you, if I may. Your microphones are currently switched off. That's quite deliberate. We'd be grateful if you keep them like that. It just stops any feedback on the call and makes the speaker's presentations much clearer. Q&A. There will be a Q&A session at the end of the session, probably 10 to 15 minutes, which we will run through the chat function, which you should see a button at the bottom of your screen. And if you'd like to address any questions that you have, please send them at any time during the presentation. I will ask them at the end. If you'd like to send them to me, you might have a choice at the bottom there, but if you'd like to send them to me, Andrew O'Kelly, I'd be very grateful, and I promise to ensure that I get all of your questions asked to our panel afterwards. I should also tell you that this session is being recorded, and we'll be sending you a link to the recording of the session when we send you your CPD email within the next sort of 48 hours after the event. Talking of CPD, then there is 1 hour's CPD attached to this event. And so in good CPD form, here are today's learning objectives. We'll be looking at the opportunity and the challenges of intergenerational wealth. 5.5 trillion is moving across generations in the next 30 years, but 65% of those people inheriting the wealth don't use the same advisor. We'll be looking at your business numbers, quantifying, I should say, this for your business. Do you have an opportunity or a challenge? And can you audit this within your business? We'll be looking at the perceived challenges, a lack of proposition for the next generation, perhaps, and profitability. We'll address also some practical steps towards the above. Do you have the right proposition and solutions in place, for example? And finally, we'll be looking at whether COVID-19 has helped or hindered. Has it changed your clients' attitudes to passing on wealth? So those are our learning objectives. Now let's get into the presentation. We've got our two speakers, Gillian and Philip. But first of all, I'm going to turn to Philip Martin from Unique Financial Planning, just to talk a little bit about himself, his business, and then we'll move straight into the presentation. Philip.
Thanks, Andrew. I'll try and keep the discussion of me to an absolute zero, if at all possible, but I thought it might be helpful just to give you the background of us as a business. We have 29 advisors operating out of 4 offices in the south, in Hampshire, in Oxfordshire, in Devon, and we also have a small office in London as well. It's a very broad-based business. It's not just focused on investment only, so we offer mortgage advice, investment advice, covering both pensions and investment, protection, and a small amount of general insurance as well. So it covers all of the spectrum. And I would describe us as operating predominantly in the mass market. So we wouldn't regard ourselves as high-end wealth managers at all. That's not what we're about. It's broad-based financial advice to mainstream customers. Although that might be helpful for giving some context for any remarks I make later on. So can I hand over to you, Gillian?
Yep, you certainly can. And good afternoon, everybody. I'm Gillian Hepburn. I look after intermediary solutions here at Schroders. And that covers everything within our Cazenove range, such as our bespoke DFM portfolio service, model portfolios that sit on third-party platforms, and also our multi-asset, multi-manager solutions. So for those advisors who outsource their investment proposition, that's the area that I work on. But what Philip and I are going to do this afternoon is is have a discussion about intergenerational wealth transfer, and also we have got some background slides that we'll use to take us through the session. And I just want to start by considering, is intergenerational wealth transfer actually an opportunity, or is it potentially a nightmare? Andrew outlined at the beginning of this session that there's around about 5.5 trillion next due to move from one generation to the next over the next 30 years. I always describe that as a wall of money moving from one generation to another. I don't know how many zeros are in a trillion. I don't know if maths was my strong point, but it just seems like a big opportunity. And I think if you look at some of the stats, the average inheritance is expected to be around about £257,000. So some interesting numbers to consider for your clients and also your business. There's loads of research out there, and many of you will have seen some of this. So I'm just going to use some of the stats as a bit of background to position, what we see is happening in the market. And this was some research that was done a couple of years ago now, but I don't expect it to have changed much. And it was done by Sanlam. And the reason I really found it interesting was because it focused on the three different people involved here. So those that are receiving the inheritance, those who are handing over that inheritance, or the donors, and also the financial advisors who should be helping to move that money from one generation to the next. And often when I talk at events, I think about, many of us today might be one, two, or all three of those parties. So this is obviously often resonates on a number of levels with people. Well, if we first of all look at the people who are due to receive this money, so roughly aged 24 to 45, so millennials typically, obviously many of them are expecting an inheritance. Interestingly, they expect to receive around about £50,000, but the earlier slides show that could be often a lot higher. They're largely, or a number of them are relying on this inheritance to help them out, and has actually put them off saving. But what about the people that are passing on the money? Well, interestingly, significant numbers of them actually care about what their family will do with that inheritance. I know from my own perspective, it's my hard-earned cash, and I would like it to go to good use. So as a result, many of these people, nearly 60%, want that next generation to see an advisor. The big challenge is that only 9% have had a conversation about it, and we'll look at that in a bit more detail as we go through the session this afternoon. And what about the advisor position? Well, significant numbers think that this is the greatest opportunity for the industry, but they are concerned about attracting that younger client. And I always say, well, one of the things that we have to keep remembering is that 76 of the people that were surveyed that will receive an inheritance want to engage an advisor at that point. So I guess the question is, why do we not do that in advance? So pulling together all of that background, I think the summary for me is always, it's a great opportunity, provided that the assets are retained. And Andrew outlined that about 65% of people receiving wealth will not deal with the same advisor. The challenge that we have is the inheritors aren't engaged with their finances or financial planning. And actually, whilst advisors see this as a huge, significant opportunity, they might need to deal differently in order to try and engage that next generation, and also to make sure that the assets are retained. And Philip, before we go on, what's your thoughts on that and the background?
Well, I think the very telling statistic for me is the high proportion of people from whom the wealth is coming who wish the inheritors to receive advice, and the very, very low percentage of people who've actually begun to have that conversation about where it would come from. So I think much of what we'll talk about, I think, over the next 20 minutes or so, all comes down to how can you start to build meaningful relationships with that generation that will inherit, so that you're doing it early enough for there to be trust in a relationship and an understanding of your professionalism, so that you can carry on looking after that family's wealth beyond the people that you currently see.
Absolutely, and one of the things I often find when we talk about this is, where do we start as an advisor business? And I've often talked to advisors about, let's keep it really simple and have a bit of an audit on the business to understand, if 65% of those inheriting wealth will move away and use a different advisor and therefore take that wealth away from my business, what might that look like in practice? And I think there's some just really simple ways of doing it. Here's an example just of a high level audit, and obviously just get an envelope out and draft it out. How many clients have you got at different ages, say 60, 70, 80? What's the assets under management that they have? And also typically what might that fee income look like for your business at the moment? Now I just put together a very simple example here where it demonstrates, and again I just took a straight 65% of that money moves, what might be the impact on the business. Some advisors have taken it a step further and said, well, actually that might be a bit of a challenge for me if that kind of fee income and assets under management starts to move. And exactly who are these people and what's the level of engagement that I've got? So again, in terms of another way of looking at an audit, take a section of or a segment of clients over a certain age. I've just put 4 here as an example. But what's the marital status? Again, assets under management, fee income. What does their family look like? And what's the level of engagement that I have with them? And you could almost argue that if I have a low level of engagement, then that money is more likely to move. So again, it's a really simple way of just trying to establish what level of my fee income and assets under management is at risk if I don't start to think about engaging with that next generation. I've also posed a question at the bottom here, is the value of the family property also at risk? Because clearly it's not just about the investment assets that will move from one generation to the other, but potentially there is a property that needs to be taken account of. And here's some stats here in terms of property transfer over the next 10 years and average property sizes. So again, what we always help advisors think about is don't just focus on the assets under management, but look at that kind of wider inheritance. And Philip, what are you doing in this area in terms of helping advisors think through the impact, not just on the business, but potentially on their future income stream?
So our business has, because of the size and the number of advisors we have operating in it, for me to do that exercise is across nearly 3,500 active clients. So it's quite a sizable exercise. We'd be concentrating probably at the upper end. I wouldn't say we've got all the answers to this. What I think we do have is a good understanding of what the problems are and some thoughts as to how we address them, and we've begun to do that. So we very much, the majority of our advisors are self-employed, so we're very much engaging with them to let them recognize that in effect they're building up their own book of business, and they need to think through strategies about, there's no point spending 10 years building it up only to spend 5 years watching it all disappear. So part of that is about replenishment, but part of it is about the deeper engagement that they have with the family. So at the centre, we're working quite hard to give them both skills and material that can then start to properly engage with that next generation early enough before it becomes too late.
Okay, but are you finding then that as a starting point, looking at the numbers within the business, it is quite a useful exercise? Massive.
And I think the property value point is usually forgotten because people only see it through the lens of their current earnings. There are obviously some complexities around that, particularly if you're dealing with a couple as a family unit where the expectation is that it will go from one partner to the next. Sure. And therefore there's a bit of a knock-on effect. But that of itself throws open all sorts of planning opportunities and all sorts of discussions. The key is how you open it up to the wider part of the family, I think.
Sure, and I think what we're starting to hear now is that there are some challenges with this, and in particular engaging that next generation. I often, when I speak to advisors, there are a number of challenges that they throw up. One is we don't really have a proposition for that next generation. We're not sure how to engage them. And actually, at the end of the day, we won't make any money from them. So they're not profitable at this point in time. We did some research. We like to do lots of research. And this was some research into millennials and their savings and investing behaviour. And I think there's a couple of key points. One is, I think it's naive to take millennials as a single cohort. they do behave very differently. If you think about the millennial generation, the top end now is about age 36, and the bottom end is around about age 20. And I know, no, look at myself in those ages, you're very different as a 20-year-old from a 36-year-old. And we did some research where we asked, you know, the millennials as groups, what are your top 5 priorities in terms of your money after daily living costs? And it was very different by age, not surprising. But from the ages of about 31 to 36, that top end, we started to see millennials really having a focus on you know, long-term saving for their family and pensions. So it kind of starts to bust the myths in a way that that generation you know, are not interested in saving and investment, and there's nothing that I can offer them. Is it a challenge that you've faced, Philip, in terms of that? What does the proposition look like, and can we make money?
Yeah, I mean, when you start to unpick that, there's loads in there, obviously. So let's take them one at a time. The affordability bit, I get. I mean, you know, giving regulated financial advice for small amounts of money coming in is very, very often unprofitable to do. I guess I would flip it round and take it from the other side, particularly for your largest existing clients. Can you afford not to? Is one thing. So I think you need to see it through the prism of potential loss leading in order to preserve assets.
Yeah.
I think the propositional piece is many and varied. I mean, sometimes people look at this and think the only obvious answer is to have some sort of digital solution that has an app that engages that generation in a way that a different generation wouldn't necessarily be engaged. I'm not sure that's necessarily right. I mean, I think for us, we will have propositions that act as an adjunct to our main proposition in any event. So, for example, every single one of us can do mainstream, simple, regular savings propositions as part of an annual review process. Likewise, junior ISAs, likewise, junior pensions for money being invested possibly from grandparents. And I think you can bridge that gap between the way that we currently give advice and fulfill it with a full digital solution that actually does start to engage a different generation in a different way. For us, the key is to start an understanding of money earlier.
Have we lost Gillian?
I think we may have done, yeah.
No, here she is.
No, I'm back. Sorry, I think my I had a slight challenge there. Apologies. The here we go.
Did you get the last bit of that, Gillian?
No, I do apologise. Wait a minute. Screen sharing again. Is that showing?
It's beginning to.
There
we are.
Sorry.
No problem. Sorry, ladies and gentlemen, but welcome to the world of online meetings.
Remote.
For some reason, my flight mode kicked in on my laptop. There you go. Sorry, Philip, I've missed the last part.
Yeah, sorry. I was saying that propositionally, I think for us, it's more about getting a regular savings culture amongst children and inheritors, think about junior ISAs, think about junior pensions. And I guess the last part of the proposition that I didn't even mention, actually, so you didn't miss it, is that obviously as a broad-based advice firm, we see mortgages as absolutely key to this. Pretty much every child of every existing client at some point over the next 3 to 5 years is either going to have to save for a deposit for a mortgage or is going to have difficulty trying to secure a mortgage. And our capability there means that we can start to build a relationship with them around something that's genuinely meaningful to them at that point in their lives and begin that process ultimately of becoming a savings client. So taken in the round, the propositional piece for us is actually quite complex. But I think to us, it's one of the principal reasons we remain involved in mortgage advice is not just because our existing clients want it from time to time. It's more because it's such a helpful gate into that next generation and their needs at the current time.
Sure, that's really interesting because a number of advisors have said to me that that's a way that they start to engage that next generation is through the mortgage. And we'll maybe come on to thinking about charging for that and how that works. Another area that advisors tell me they have to consider when they're building a proposition is just around the investment proposition and the ability to have and to offer potentially a sustainable or an ESG solution, because they're finding that that next generation is very interested and keen to put their money to good use. I would probably challenge that in some ways. So certainly the data that we're seeing coming through in Schroders is that it's not just a millennial issue now. And I don't know about what your thoughts are in terms of the investment proposition.
Well, I don't think necessarily it's just sustainable. I think probably the pace at which the industry manages to develop solutions will be way behind the actual demand. I was at something last year and there was an interesting stat came up about millennials, which is that the biggest individual single cohort that they've managed to identify are actually vegan. And yet there'd be nothing in an investment sense that talks about the logicality of having an investment in somebody that makes sausage skins, for example. So it could be that we're way behind the curve on how this is actually going to need to look. You there, Gillian?
Yeah, sorry, I'm having a few problems.
But I think in essence, we'll always manage to find an investment solution once we start getting the basic principle right.
Bear with us, ladies and gentlemen. We'll be right back with you. Just a temporary issue, I'm sure.
Couldn't decide if it was me there, Andrew, or Gillian, but I think it's Gillian, isn't it?
I think so, yeah. I think Gillian's just trying to reconnect.
Andrew, I'm back.
Well done.
Sorry, I don't know what's going on with my laptop.
That's okay. Everybody's bearing with you. We all share your pain.
I'm sharing my pain here. Let me just.
Absolutely.
Share screen. Here we go.
Yeah. All good.
Okay.
Yeah, absolutely.
Cool. I think we've lost Philip.
No.
No, he's there.
No, I'm here.
We good?
Yeah.
Okay. So, Gillian, if you're all set and comfortable, you want to carry on?
Yeah. I don't know what's happening with our internet here actually today, so I do apologise. The joys of working from home. So if we move on, I know we talked a little bit there about the investment proposition, but one of the things we've talked to advisors about is that whole proposition and what are some of the other considerations that they might need to have when they're building something for the next generation. So interesting, it was things like charges. So how does that next generation want to pay? Because certainly the research indicated that they want to pay when they get advice and not necessarily on an ongoing basis. So I think that opens in, not for today, but that whole fixed versus percentage charges debate. What about technology solutions? And obviously, the recent the recent situation that we've been in means that people are using technology on an increasing basis. So can I put together a kind of light touch proposition that's based around using more technology? But actually something that you mentioned as well, Philip, was do we need to have different skills within our business to make sure that we can engage effectively and facilitate some of these kind of family conversations, because they could be challenging. What's your thoughts around some of those areas?
Well, it covers loads of stuff, doesn't it? I mean, I think probably most advice firms would agree that one of the few positives to come out of the last 6 or 7 months of lockdown is that it's accelerated the use of technology within some advice businesses. It certainly has within ours. So advisors who would have been reticent to hold annual reviews, for example, by Zoom, or FaceTime or other means are now seeing the huge benefits in their productivity from not having to travel to present numbers that can easily be shared in a much more conducive environment. So I think that will happen. I think in terms of targeting technology at this audience, I think we would tend, merely for the opportunity to start to engage with that audience, to regard that as an adjunct to the earnings that we make from the principal client. So I would have no issues at all around, mortgages being arranged without an admin fee for us, around regular savings being set up, including fact-finding advice at no cost whatsoever, regarded as just an adjunct to do that. Mainstream protection, likewise. I think that becomes very important to start to think about it as a family unit if you're serious about trying to engage with that generation. I think too, it's also, we're finding that we're taking some of our advisors back into old skills that they had but have perhaps been forgotten. So putting wills in place and powers of attorney gives an opportunity to start to talk to the people who are mentioned in wills and powers of attorney about what is expected of them in fulfilling that role, which of itself starts to open up an opportunity and a dialogue around the things that you can do for them, both individually and as part of the family unit. So we're using all of these collectively as ways into that next generation.
Sure. I mean, I think on the right-hand side here on the slide, one of the things we've often talked about is just don't have any biases and don't assume that that next generation is only interested in technology solutions such as things like robo-investments, for example, but they do want to meet with advisors, and the key point being that bottom bullet point that 76% said they want to engage with an advisor when they inherit the wealth. So I guess the question is always, why don't we do it earlier, and what are the range of products and solutions that that next generation need? And
there's obviously there's obviously a fantastic opportunity to start to bridge the two. I mean, everybody recognises that mortgage advice is very, very helpful in an advice business because it's a tangible product that somebody wants that has instant benefit now, and generally they've got a need because they can't source it themselves. The opportunity to start to facilitate that lending for the children of existing clients in the context of money that might come to them as an inheritance to offset that debt at some point down the line is very, very strong. It needn't just be a transactional mortgage. It can have the context of the likely inheritance as well. And that helps to bring it all together.
Sure. I mean, mortgages are really interesting, actually, because obviously we've seen news recently about the way that lenders are changing the way that they do things with respect of the bank of mum and dad. In the last few years, I think the Bank of Mum and Dad became something like the 4th largest lender in the UK, with the average loan being about £24,000. So it's not an insignificant amount of money. The big question I would always have is that money being treated as a loan or a gift? And absolutely opportunities for advice around all of that piece as a step in terms of intergenerational wealth. I also hear obviously a lot about advisors working with families where the grandparents potentially have a concern that passing on money, it'll get, I guess, somewhat squandered in some way, and setting up pensions for children, again, great opportunity to make sure that that money is put to good use, but it can't be used straight away. And the other areas in terms of children's education and potentially paying for school fees. And for me, that one's a really interesting one because it kind of relates to that difficult conversations that we mentioned. It's a much softer conversation to talk to parents about handing on money to pay for the grandchildren that they love so much in their education, rather than saying, if you give us a chunk of money and don't die within 7 years, then the tax man doesn't get it. So I guess, isn't there, there's ways of framing some of this and helping families think through the benefits of passing on wealth at different stages.
Yeah, agreed. And because it ties into an easily understood need and benefit.
Yeah, sure. And one of the things I've also done over the last year and a half, and I've been talking about this subject, is just simply collect lots of really good examples of what advisors are doing. I've got a few here. One advisor talked to me about putting in place what she called the family Bible, and we actually do produce a bound book for these families with different copies for everybody that talks about Not so much the amounts of money that are moving from one generation to the next, but where it's held, what products it might be in, who are the people to contact, such as solicitors, accountants, or third parties that might be involved. And really laying out what is going to happen with that money, so making it clear, but the production of the actual Bible, as they call it, makes the conversation much easier to have within the family. Another advisor talked to me about, where they can in his business, they only ever talk family advice. So the word individual advice just doesn't become part of it. And it's about, it's just all integrated into the fact find. Similarly with things like use of trusts, again, an advisor talked to me about a great way of engaging that next generation when they're putting in place trusts and power of attorney is, again, talking about the process with that next generation. If you are a power of attorney or a trustee, what does that mean in practice? So actually taking the money conversation away from it. Is that some of the things that you've covered within your business, Philip?
Yes, I mean, I mentioned the trust and power of attorney one shortly before. The family Bible one, we call it something different, but it's essentially exactly the same. I mean, clearly that helps with fact finding anyway, because you're starting to properly understand everything that's in place, particularly around protection, when very often,
Sure.
Existing clients will be woefully underprotected, and that gives an opportunity to open that conversation up. So yes, across both of these, definitely.
Yeah,
I think the last one, but before you get into your last one, I think the other thing that would be, we've seen, I know your future client one is for a different cohort of children, but I think I like also the idea of starting to talk to the children of existing clients at the point that they go away to university or further education, to just explain the basics of how to govern money in a sensible way, just as another touch point into to your expertise.
Yeah, and again, it's back to the earlier point we discussed, in that you might not be making money from some of those conversations, but it's about protecting the wealth within the business and thinking about how you retain it. I mean, that last example that I put up, I talk a lot about. I spoke to an advisor from Prague when I was speaking at an international conference, and he came and told me about how he engages the children of clients from the age of 10. Now that feels a bit extreme to me, but it certainly works for their business. And they talk to these young kids about, just simple savings. They bring them into the office, they meet everybody, they know who the advisors are. And then they bring them back into the office in groups, and actually talked about taking them away for weekend trips and stuff, where they talk to them about starting university, getting into debt, what loans look like. Then they engage very much at key life stages, like when they get married, when they want to buy the first house. He said, we're with them every step of the way. And all of that is about giving them advice when they need it, but also protecting what can be a lot of family wealth within their business. His mantra is absolutely, we don't want to lose a penny of the wealth that we've created and worked very hard with our clients to create. We don't want to lose a penny of that. Because we simply didn't engage with the next generation. So it's some interesting things that we're seeing, not just in the UK, but on a global basis. We mentioned earlier as well that some of this can be a challenge in terms of just having what could be seen as difficult family conversations. So some of the areas, for example, that we see is care home planning, where people are really nervous about passing money on to that next generation, because they simply don't know what they might need in later life to fund care homes. Obviously, IHT opportunities I've alluded to. Other areas, though, that can be quite challenging are things like, is the wealth being shared equally amongst family members? An advisor spoke to me about this just the other day, where a family that they were working with had different siblings, all at different stages, but also at different levels of wealth, where there was a view that as a result, the money, they didn't want to share it equally amongst the family members, but the danger was there was a concern that maybe the person that appears outwardly to be doing well, lovely house, cars, lots of holidays, kids in private school, for example, but actually they were significantly in debt, and they were part of that generation, as we talked about right up front in this session, that are waiting on the wealth to move to them to actually fund the debt that they're getting into. But these are quite difficult conversations to have. Even things like skipping generations appears to be increasing, where grandparents are thinking that I'll just move the money and share that equally amongst grandchildren. You can understand why that might happen, but equally it's back to the family Bible. Does everybody know that that's going to happen? The one I always talk about as well is how are we going to manage the stepchildren? If we talk about challenging conversations, that can be a difficult one in terms of splitting assets across families. And certainly, stepchildren exist. If we look at the marriage stats, 42% of marriages end in divorce. And I love the analogy of the silver separators and the silver splicers. So I used to just talk about silver surfers, but according to the statistics, the number of people aged 65 and over getting married and then and divorced in greater numbers, and significant numbers of those have children. So I think that whole stepchildren piece is there, but it also leads to some potentially challenging conversations within families about where that wealth is going and why. Again, is that areas that you focus on, Philip, within some of the client conversations?
We wouldn't naturally focus on it. I mean, it wouldn't be, for example, a key part of the ongoing review unless it was absolutely particular to that family.
Yeah.
Also, I guess for the majority of our client base, the accumulated wealth wouldn't be at such a level that it becomes a real practical problem. But I can see how more generally, particularly in the higher wealth space, this is absolutely an issue, and I suspect isn't touched to anything like a degree. It just goes in the bucket under difficult conversation that we'd rather not have.
Yeah, absolutely. Or we'll leave it to the solicitor to deal with.
Somebody else's problem.
Yeah. One of the things we've also talked about is, and throughout the session, is about protecting the income stream within the business. So what are the benefits of really considering an intergenerational wealth transfer strategy? And I've talked a lot about the impact on business valuations, particularly for those who are looking for exit strategies. Now, I appreciate not everybody is, but you could be focusing on both your income stream or an exit strategy at the very point where people are looking to move out of the industry. They clearly want to maximize the multiple of their business for a potential sale. And I find this segmentation chart really useful to help start to think about that. If you look at the right-hand side, we've got this whole area of later life where the complexity of client needs are greater, potentially as they move into drawdown and some of this IHT planning. And at that point, their assets might be reducing. I used to talk about the 2 Ds, which were sadly death and drawdown, which are depleting assets. And if you're not actually filling the hopper up, so to speak, in that left-hand side, in terms of bringing new people into the business that are actually there anyway within the families, then what's happening is that the valuation, the assets within the business are reducing, and hence potentially valuations. So it's about looking at right across the segmentation and seeing where are the clients and am I managing that later life segment. And again, Philip, is this something that your business thinks about and considers?
Yeah, we're massively focused on this, particularly with, you mentioned drawdown here. So these are 2 very crude bits of MI, but we review for each advisor their ongoing regular withdrawals from their book of clients in terms of either withdrawals from a GIA or drawdown from a pension relative to their ongoing regular savings number, obviously looking for one to be greater than the other. And likewise, we'll look at lump sums relative to money taken out in lump sums, like tax-free cash or whatever else it happens to be, to see that gap is constantly increasing. I think regular saving is just a massively undershot part of the industry post RDR. Since the commission incentivization around indemnifying regular savings many years ago was removed, it seems to have gone as a conversation. Likewise, so many people are underfunded for income and retirement, and we don't have very straightforward ways of starting to describe what does that underfunding look like, and how do we get a basic rudimentary plan in to chip away at it through regular saving. Also, platforms have been very slow in introducing stuff that used to be straightforward. I mean, I bet you loads of people on this call will remember when regular savings into life contracts would be automatically indexed and would increase every year to keep pace with inflation. That doesn't happen yet in a platform world because of where the contracts exist. And so it's vital to us that that regular savings impetus is not just set up, but is also reviewed on an annual basis to continue to have real worth as it's going in and continue to rise. So the regular saving part has become a real focus in our business because annual reviews are taking place anyway. Why wouldn't you be discussing it?
Why wouldn't you do it? Yeah, sure.
Both for the existing client and for the children.
Yeah, yeah. But again, you know, this segmentation we've found advisors really starting to think about how do we segment clients, not just in terms of the assets under management, but in terms of life stages. So this chart's been really helpful in terms of thinking through not just pure segmentation, but how does it impact intergenerational wealth? And how many clients have you got in each of these different segments, and what does that look like? And again, that goes back to some of the audit stuff and the numbers that we talked about earlier. I'm just going to move on finally before we take some questions into some of the impacts that we've seen in terms of COVID-19, and for me there's a number of interesting things going on, and it's always an interesting debate with advisors as to whether or not they're experiencing it. And first of all, I think there's a question around the actual inheritance itself. You know, so are we seeing some of those inheritances potentially reducing as a result of the recent pandemic? An ABI report indicated recently that 40% of pension cases have now reached withdrawal rates of 8%, which is quite scary. And if that's the case, then the chances of some of those potential pensions and pension pots being handed on to the next generation are looking less likely. You know, significant numbers of people have also significantly reduced or stopped their pension contributions in the last sort of 6 months. And again, that's, you know, that can lead, you can understand why that's happening in many instances, but again, the long-term impact of that could be quite challenging, and particularly and potentially reduce the amount of money that's moving from one generation to another. Many clients are talking about the impact on retirement, worrying about their income lasting, and choosing now not to gift. And you know, I mentioned earlier care homes. So sadly, this whole pandemic's shone a light on care homes for a number of different reasons, but one of which is people start to really think about funding their care, what that looks like, and whether or not my financial plan will actually see me through. I don't know, are you seeing clients, Philip, thinking about that whole inheritance piece and also trying to, and I guess dipping into the pot, so to speak, as a result of the recent challenges? Yeah,
I think honestly, it's going to be too early to say, to know exactly what the impact of this is going to be on overall sentiment and how it ties into planning. I think you might have just as many people who say live for today and spend it while you can, as you will to have people who will recognise the need to make sure that the pot runs over longer. The one other thing that I would add to that is that the one thing we have noticed in doing annual reviews with clients is that conversations around ensuring people are adequately protected are far, far more straightforward. I mean, pretty much everyone is going to end up knowing somebody who's either had this extremely badly or has sadly lost their life as a consequence of it. And I think it's shown the need for adequate protection in all forms. Income protection, which is obviously woefully under-advised in the UK anyway, you know, in particular, but even just basic cover as well, is now far easier for the advisors to address than it was before. People are prepared to spend money on that product that would have perhaps not wished to before.
Yeah, I know we talked earlier when we were preparing for this about not seeing the current crisis as an opportunity. It's not the way we want to phrase it, but I think he said if this opportunity leads to more people actually looking at their protection, then you're not going to apologise for it.
I'll never apologise for it. You know, we're massively undercovered. If the advice industry isn't there to make sure people are adequately protected as the bedrock of a sensible financial plan that sits under their assets, what on earth is it there for? Yeah. You know, I don't think we should apologise for it at all.
Yeah, sure. And then And the other area that we saw in terms of some of the changes, that very much a huge focus on wills. So, it's scary, 61% of adults allegedly have still not written a will. Again, you don't want to make an opportunity out of a crisis, but clearly there are opportunities for really good financial planning discussions with clients. Just see that DeVere Group reported a 76% increase in demand for wills during March, and I'm sure that's continuing to increase. The other area advisors said that they were speaking to clients about, though, was the whole tax planning. One of the concerns clients had was, as somebody put it to me, Rishi Sunak is going to be out with his begging bowl shortly, because whilst the furlough scheme has been fantastic in helping people through this, through these challenging times, clearly the cost of that has to be borne somewhere. So there's a fear of things like rising taxes, changes in some of the tax regulations, and should people start to lock into some of them now before some of these changes might happen. Now clearly nobody has a crystal ball in terms of what that could look like, but again, is that an area that you're seeing clients just beginning to think about?
Yeah, well, in my 30 years in this industry, high rate tax relief and its removal has come round every February as a reason to talk to clients in the next 8 weeks, hasn't it? But I think possibly this might be the first time that it genuinely is under threat. Likewise, the triple lock on pensions, it's hard to see that surviving. And I think both of those have enough traction, I think, in the wider media for clients to see that potentials are being chipped away. So I'm not one greatly for the fire sale either, because I think we need to have a longer term perspective on it. But I think it's pretty clear that some of the things that have been advantageous in the past may not be around, and that will accelerate financial planning now, I think, yes.
Sure. And lastly, just to close off before we take any questions, certainly what advisors are also saying is that, again, we spoke earlier about, only 9% are having family conversations, but very sadly, we've all been locked up, often as families that don't often spend as much time together, but also watching the news night after night and seeing what's playing out in front of us in terms of mortality. So the ability to have some of those, what could be challenging and difficult conversations might just be easier now as a result of what's happening. It's becoming a bit more real. So many advisors saying it's really prompting some of those kind of difficult and family conversations that we don't want to talk about them, but it's potentially a bit easier. So again, I don't know if that's something you're finding, that people are just more amenable to having conversations about passing on wealth and about what might happen after they pass away.
Yeah, I think they are. That makes the conversation easier. I think, even within our base, we've got some advisors who I think are really skilled at it, and some who have quite a reticence towards it. So I think there is a skill issue amongst advisors as well, which we can tackle ourselves. Very often the fear of discussing this is not in the client's mind at all, it's in our own. And once you cross that Rubicon and start to do it, it becomes easier. And I think we do a better job as a consequence. So it's, it's something I expect my advisors to pick up.
So really, in summary, what we've covered is that there's potentially a huge opportunity for money to move from one generation to the next. Advisors are starting to think about, what does that mean for my business if we don't retain the assets? And then how do we actually engage and build propositions to engage that next generation, and maybe accept the fact that it won't instantly be profitable, but we'll be doing the right thing for the family and our business over the longer term. I think COVID-19 has just given us some different angles on all of this to think through in terms of opportunities for financial planning and to work with clients. So I'm just going to hand over to Andrew, I think, who is hopefully going to pick up some questions. Andrew?
Yes, Gillian and Philip, thank you both very much. That was very interesting, very insightful, I thought. We've had one or two questions in already. Thank you to those who've already submitted questions. But for any of you who'd like to add some more, we've got about 10 minutes, and so there's plenty of time. And as I said, I will endeavour to ask all of your questions. I'll start with one. We sort of touched on it, and the question is, I'll just read it straight out. Do you see the Chancellor eyeing up this wall of money via IHT?
I might let Philip answer that one, but I mean, clearly there's a lot of discussion in the market and with clients about that potentially happening. So as we said, nobody has a crystal ball, but clearly they've got to be looking somewhere in order to fund some of this. Philip, what's your thoughts?
Usually changes to IHT are driven by the politician's perception of how it lands with the public. So, you know, changes to this will be as much driven by kind of fear of death tax headlines, you know, like there were from the election before the last one. We can all remember that far back. So I think if the groundwork is laid, I think it's perfectly possible, I think you'll see changes to IHT. But I think we're all in the realms of crystal ball. I mean, I wouldn't sign off advice that used that as a rationale for a plan that was changing, unless it was in the context of something else. But I think clearly the cash is going to have to come from somewhere, and accumulated wealth is clearly one easy target.
Sure.
Okay. I've got another one here, actually from our reporter, Sophie King. Have either Philip or Gillian found that advisors might be challenged when it comes to what the donor thinks the money should be used for compared to the person who will inherit it?
I can't really decide. Is it implicit in that question that you're thinking that the donor wants the money to be used for a specific purpose that the person inheriting it does not?
I would say so.
Yeah.
Well, ordinarily, if somebody giving it was so clear about their intention, wouldn't they just be outlining that in the will or attaching conditions to it?
You would kind of hope so, and I would go back to the research actually that said up front that I think from looking at the stats, 40% of people passing on wealth really care what their family are going to do about it. Now you could argue, I'm going to be 10 foot under, so does it make a difference? But clearly for some people it absolutely does. And they want, I think it was 60% said, I want them to see an advisor. So I want something sensible done with the money. But I guess, Philip, it's back to your point. If there's really specific requirements, then they really need to make sure that that's documented in the will. Yeah. Or in a side letter, or, you know, I'm not a legal person, but you would assume if they cared that much, then yes. But maybe then there's a duty also for the parents to introduce the financial advisor. Maybe it works both ways, you know?
I would agree with that. I mean, I think if the stipulation here is whatever you do with it, don't squander it, you know, on racehorses and red in a casino, then the way to do that is for me to introduce you to my financial advisor. And of course, I would say that, wouldn't I? But that feels like a natural bridge between the two.
Yeah, and maybe we all have different definitions of squandering it.
Well, indeed.
Okay, I've got another one here. What are the advantages and disadvantages of suggesting the next generation join by opening up a new general investment account seeded by capital from the older clients where they are all joint members stroke owners?
So I think what's been suggested there is that some existing capital is pooled and used collectively for the benefit of the people who will inherit it, and that seeding is required either to set up a new fund or something that has specific investment objectives that the people inheriting want it to have. Is that what's implied there? Gillian, what do you think? I'm not sure I really understand the question.
But actually, I was going to take a slightly different angle on this one, because this is, I think, the where you could see the benefit of platforms, for example. So as you know, that many of the platforms will allow kind of family type accounts where clients can benefit from consolidated reporting across families, provided everybody agrees, but also discounted admin charges based on the volumes of money invested. So, you know, clearly there are some opportunities and benefits of consolidating money, but still potentially having that held separately for different members of the family group.
But that would need the money cascaded over to the person that's going to inherit it, because you would just get the benefit by the linking, wouldn't you?
Yeah, no, surely it would. Yeah.
I've got a question. We've spent this session talking about intergenerational wealth, But what about spouses and partners? Isn't that an important area too?
Yeah, I think it's a really important area, Andrew, because we often overlook it and assume that intergenerational means down the way as opposed to across the way, if that makes sense. And there was a really interesting survey that came out from McKinsey that talked about advising women. And in fact, they talked about how in the US, and I'm sure the UK won't be different, but that 2/3 of baby boomer wealth is in joint households, and that they reckon that there will come a point where most of that wealth will be held by women, and that interestingly the number I quoted, 65% of people inheriting wealth will change advisor, and they said that if it's a widow, it's higher than that. It's 70%, which is a scary number. And they looked at why that was, and they said there was two key areas. One is they often felt shut out of the conversations with the advisor, and they felt overlooked. And they also were a bit nervous about, and I'm just quoting the research here, they were scared to ask what they deemed basic financial advice questions. So they were kind of scared a bit of taking part in the conversation, and they felt that the advisor didn't speak enough to them. And as a result, they moved. So I think it's a really interesting point in terms of managing those spouses that will clearly inherit significant amounts of money.
Sure. Another question here. Do you see buy-to-let being used as a cash cow for raising taxes, IHT, etc.?
In as much as they can be taxed as second properties.
Yeah, I would think so.
I assume. Well, it already is. I mean that particular part of the market is already being punitively taxed relative to where it was 2 or 3 years ago.
Mm.
Yeah, it's really difficult, isn't it, to predict what may or may not happen in terms of trying to pay for this, but clearly anywhere where there are tax advantages, then they've got to be examining those, I would imagine.
Yeah, I mean, it's quite easy to just assume that all the money has to be paid for from tax rises. This will be a blend of tax rises, how quickly the economy recovers, and therefore tax receipts in general rise, and indeed the ability for the country to borrow over the longer term at favourable rates. So it's going to be a mixture, isn't it?
Sure.
And we don't.
On the tax front, do you see higher rate pension tax relief being changed?
Oh, I think that's odds on personally, but as I said earlier on, we've been predicting that every year for the last 25, haven't we?
We have. Right. Well, I've got time for one final question, it's interesting to me that when you run these kinds of events ordinarily with an investment house, they spend most of their time talking about their funds rather than anything else. And so it's just interesting to me, what was it that possessed Schroders to pursue this line of intergenerational wealth? What's so important in that to yourselves, Gillian?
Yeah, it's a really good question, because I do get asked this a lot. I guess firstly, for me, it's a topic I kind of feel passionately interested in. But also, I look after investment solutions for financial advisors and intermediaries, and we have a range of solutions. But my mantra is always, if you have a solution, it's got to address a problem or a challenge. And I'm always really keen to think through and work with advisors about what are some of the problems and challenges, and how can we help think through solutions that are not just necessarily investment focused. I mean, for intergenerational wealth transfers, I think I alluded to when we were talking through the session that intergenerational wealth transfer means that you need different propositions for different generations, and equally, therefore, you need different investment solutions for different generations potentially. So if you look at people passing on wealth, many of them may require, for example, a bespoke portfolio from a discretionary fund manager. Equally, for those doing simple savings and investments, it might simply require a model portfolio solution on a platform or a multi-asset fund. We've just actually launched a new range of multi-asset solutions in the blended active passive space. So again, it's about thinking around what are the problems and challenges that we can solve from an investment perspective, but also how does that fit with some of the other problems and challenges that advisors are working through with their clients.
I see. Okay. Well, thank you very much, Gillian.
And I guess nobody's going to ask the question as to who is my internet supplier.
I think that you've been incredibly persevering in making sure that in your repeated attempts to get back in. And I think testimony to the interest of what you and Philip have been discussing is the fact that throughout all of that, we didn't lose any participants at all. So thank you
for being with us.
Thank you, Philip, both of you. Well, I think that sort of wraps it up for today. But before we lose all of you, I can see some quitting out already. Before we lose all of you, just a plea to tell you about, I told you this was the first in a series of these working lunches. And if you were interested in what we discussed today, let me tell you about 3 more that are upcoming. One this Thursday, the 20th, in partnership with Simply Biz, we'll be talking about a variety of compliance issues with a panel of 3 people from Simply Biz. I think that'll be interesting. Same time, 1 till 2, all of these. Next Wednesday, at the 26th, Philip and Gillian will be back and we'll be talking about building confidence in ESG fund selection. And then if you're an advisor in Scotland, we've got a session on Thursday the 27th, especially for you in conjunction with Compliance First, which again will be talking about compliance issues. Over the coming weeks, we hope that we'll be able to add some more of these for your usage. But in the meantime, that wraps it up for today. All that remains for me to do is to thank our speakers, to Gillian and to Philip. Thank you both very much for a hugely insightful hour. But let me reserve our most profound thanks to you and thank you, our delegates. Thank you for your company for this last half hour. I hope you've enjoyed it and we look forward to seeing you again soon. Bye-bye.
Thank you. Bye, guys.
Thank you.